Let me start today's video with a quick question. Do you know the number of Demat accounts in India right before COVID? Just make a wild guess. Well, it was roughly 4.1 crore. And if you think this number is huge, wait. It has surged over 3 times, hitting almost 13 crores by September 2023. The AUM of the mutual fund industry has also grown fourfold in the last decade, from 10 lakh crore in May 2014 to almost 46 lakh crore in July 2023. And how can we even forget IPOs? You must be feeling frenzy all around you, aren't you? These numbers underscore a clear trend. More and more Indians are jumping into the stock market bandwagon. But here is the catch that many investors tend to overlook: taxes. See, understanding the tax implications on your investments can be an eye-opener. Why, you ask? Well, first off, it lets you understand your profits after tax. And secondly, by staying on top of your tax payments, you reduce the likelihood of interest penalty and retain more of your hard-earned money. Hello, I am Vishvajit Sonagara, founder of Queco, India's leading tax filing platform. In today's video, I'll help you understand everything about income tax for investors. See, we'll discuss this topic in depth, so stick with me. And I promise you, you won't need to watch another video on taxation for investors after this. We'll start by understanding the difference between an investor and a trader, different income sources for investors, taxation on capital gains, and taxation on dividends, different ways to save taxes as an investor, and lastly, how to pay and file taxes. But before we begin, hit that subscribe button and notification bell so you never miss out on any of our upcoming videos. Without any further ado, let's get started. So whenever we talk about stock markets, you will find two main characters: investors and traders. Now what sets them apart? Simple. It's all about intent. So picture this. If you are in it for the long haul, aiming for capital appreciation down the road, you are an investor. On the flip side, if you're dancing in and out of stocks, playing the game of short-term price fluctuations to snag some quick profits, well, that makes you a trader. Technically, investors are those who take delivery of stocks in their Demat accounts and play the waiting game, while traders are people who hustle with intraday and F&O trading. Now, it's a lot to cover both investors and traders in one video. So today, we are zooming in on taxation for investors. But if you want us to make a separate video on taxation for traders, let us know in the comments, and we'll make another video focused on traders. All right, no more waiting. Let's jump right into the next section. Let's break down income tax for a minute. It categorizes your earnings into 5 heads of income: income from salary, house property, business or profession, capital gains, and income from other sources. I won't bore you with the nitty-gritties because most of these are as straightforward as they sound. For instance, if you are employed and received monthly paychecks, that falls under income from salary. Got some rental income? Well, that falls under income from house property. Now, talking about stock and mutual fund investors, they can earn money in any of the following 2 ways. A capital appreciation. Picture this: you bought stock A for 100 rupees and you flipped it for 120. That sweet 20 rupees difference is your profit. Dividends. Let's understand this with an example. Say a company earns 1000 rupees in profit. It needs 800 rupees for ongoing and future business activities. And the remaining profit of 200 rupees is distributed amongst its shareholders. Now this income is called dividend income. So the money you earn from selling stocks or mutual funds at a profit is called capital gains, and it falls under the income from capital gains head. And when the cash flows in the form of dividends, that's tagged as income from other sources. Let's understand tax implications on capital gains first. Alright, before we dive into tax talk, I want you to understand a key concept: holding period. Now, the holding period is basically how long you hold an investment in your portfolio. It's the time from buying to selling. Quick example: buy a stock today and sell it exactly 3 months later. Your holding period is 90 days. Got it? Great. Depending on how long you hold an investment, your capital gains split into 2 subheads: short-term capital gains or STCG and long-term capital gains or LTCG. And guess what? Your tax rates varies with these distinctions. Now check out this table. In case of equity investments like stocks or equity mutual funds, a holding period of less than 1 year is considered short term and the tax rate is 15%. And if you are in it for more than a year, long term, and the tax rate becomes 10%. Now quick quiz for you. Listing gains from IPO taxed at 10% or 15%? Drop your answers in the comments. Okay? Let's move on to foreign equity shares like US stocks and unlisted shares. If you're holding on for less than 24 months, it's short term, and over 24 months is long term gains. Tax rate on STCG as per your income tax slab rate, while LTCG is taxed at 20% with indexation benefits. Now, I won't delve too deep into indexation benefits, but think of it as the government allowing you to adjust your gains for inflation, saving you from taxes on the entire capital gain. Now let's peek into the world of debt instruments like bonds and debentures. If you're holding them for less than 3 years, it is considered short term and the tax rate is tied to your tax slab. While a holding period of over 3 years is considered long-term capital gains, which is taxed at 20% with indexation benefits. But remember that the rules for debt mutual funds were changed from April 1, 2023. No matter how long you have held them, debt mutual funds are taxed at your slab rates without any indexation benefits. Calculating tax liability for investors. Now let's decode the math behind calculating capital gains tax with a simple example. Meet Rahul. He invests 10,000 bucks into 10 stocks of a company A. A few months later, he cashes them in for 15,000 rupees, earning a handsome 5,000 rupees in profit. Since the holding period is less than a year, it falls under short-term capital gains category. Thus, he'll have to pay 15% tax on his gains, which is 750 rupees. But hold on. Company A was just one stock in his portfolio. Rahul might have a whole portfolio of stocks and mutual funds, each with its own tale of profits and loss. So Rahul will have to add up all his gains and losses and then calculate the total tax liability on his net capital gains for the entire financial year. And the same rule book applies when you are dealing with other financial instruments and asset classes. Remember that you will have to be careful about rightly categorizing your gains into short-term and long-term, and then calculate the tax liability for each category as per the applicable tax rates. I hope you are keeping up with me till now. If you are enjoying this video so far, let me know by giving a thumbs up. Alright then, let's talk about taxation on dividend income. Dividends. Who doesn't love that little extra pocket change? I still remember my first dividend from Enfi. Just a few hundred rupees, but it felt like hitting the jackpot. How about you? Which was your first dividend paying stock? Share it with us in the comments. Now let's get back to taxes. Whether it's a small windfall or a big bonus, this extra cash in the form of dividends comes with a side of taxes. As per the Finance Act 2020, dividends are taxable in the hands of investors or shareholders at the regular tax slab rates. And you've got to report these earnings under income from other sources head in your ITR. Now here is a twist. If your dividend payout goes past 5,000, the company or mutual fund house will deduct a 10% TDS. So for example, Karthik receives 6,000 rupees in dividends, crossing that 5,000 rupees mark. Result? A 10% TDS snap, leaving Karthik with rupees 5,400. But there is more. The remaining tax journey continues under the income from other sources head at Karthik's slab rate. If Karthik finds himself in the 30% tax slab, he'll have to fork over the remaining 20% tax on the full 6,000 rupees, which is an additional tax of 1,200 rupees. Hope this was crystal clear. Now, apart from dividends and capital gains, there's a special case that I wanted to highlight. Gifting of shares. Yes, even gifted shares come with a tax tag. If you receive share worth more than 50,000 rupees from non-relatives, the entire value of those gifted shares will be taxed at your slab rate under the income from other sources head. If you want to learn more about gifts and how are gifts taxed in India, you can watch this video on our YouTube channel. We have covered everything about gifts in detail here. We'll put the link in the description below. Okay, then now let us understand the different ways you can save taxes as an investor. Do you remember what is the tax rate on STCG in case of equity investments? It is 15%, while tax rate on LTCG is 10%. What does this mean? This means that the government is encouraging long-term investments by providing lower tax rates. And this is not the only benefit. The government also gives an exemption of up to 1 lakh rupees on long-term capital gains earned in a particular financial year. So if you earn 80,000 rupees in long-term capital gains from selling your stocks, you'll have to pay zero taxes on these profits. And if you earn a LTCG of, let's say, 1,20,000 rupees, you'll have to pay 10% tax on the amount exceeding 1 lakh rupees, which is 20,000 rupees. Hence, your tax liability will be just 2,000 rupees. Remember that this 1 lakh tax exemption on long-term capital gains is only applicable for equity investments like stocks and equity mutual funds. Now, what if I tell you that you can pay even less tax on long-term capital gains? Yes, that's possible using tax harvesting. Now, tax harvesting leverages the 1 lakh tax exemption on long-term capital gains from equity investments. It is quite simple. Whenever your long-term capital gains for a given financial year are about to exceed rupees 1 lakh, book the profits and reinvest the entire amount. Let us understand with the help of an example. Suppose Rahul invests rupees 10 lakh in equity mutual funds in 2023. 1 year later, his investment appreciates to 11 lakh, and after 2 years, his invested capital becomes 12 lakhs. He decides to sell his mutual fund units after 2 years, and hence his long-term capital gains would be rupees 2 lakh. His taxable capital gains be 1 lakh rupees after the 1 lakh tax exemption, and hence his tax liability will be 10,000 rupees. Now let's take another case where Rahul uses tax harvesting. So at the end of year 1, he will book his profits and reinvest the entire 11 lakh back into the same mutual fund. This way his compounding doesn't break as he reinvests the entire capital right away, and he doesn't have to pay any taxes as his long-term capital gains have not exceeded 1 lakh exemption limit. Similarly, Rahul again sells his mutual fund after second year, and he'll pay zero taxes because now his invested capital is not 10 lakhs but 11 lakhs. Hence his long-term capital gains is 1 lakh rupees, and thus there is no tax liability. Now Rahul can do this every time his long-term capital gains are about to exceed 1 lakh and pay zero taxes on his entire capital gains without breaking his compounding. Isn't it crazy? Another similar concept to tax harvesting is tax loss harvesting. Let's say you have invested in the market and made a fair share of gains, but also have few poor performing stocks and mutual funds. You can simply sell those equity investments at a loss to set them off against your capital gains before the end of financial year, thereby reducing your tax liability. For instance, Rahul has realized short-term gains of, let's say, 50,000 rupees, while he has unrealized losses of 20,000. He books the loss and effectively reduces his net gains to 30,000. Thus, he will have to pay 15% STCG on 30,000 instead of 50,000, which is 4,500 rupees, saving Rahul 3,000 rupees in taxes. Now you must be thinking, what if I don't have any capital gains this year to set off my losses with? In that case, you can carry forward your capital losses for up to 8 years and set them off against any future capital gains. Now there are two things to keep in mind. One, you are allowed to set off capital losses across asset classes. Capital losses from one asset class can be set off against capital gains from another asset class. For instance, capital losses from stock markets can be set off against gains from real estate and vice versa. And secondly, long-term capital losses can only be set off against long-term capital gains, while short-term losses can be set off against both short-term and long-term gains. I hope that's clear. I'll move on in the interest of time, but in case you need a detailed video on this topic, let me know in the comments. Another common way to save taxes on your long-term capital gains from stocks or mutual funds is by reinvesting the profits in a residential house property. This way you can get an exemption on the reinvested amount under Section 54F. Again, I'm not going to go into the nitty-gritty here, but if you want to learn more about this, let us know in the comments and we can make a separate video on this. One last tax-saving tip is forming an HUF and opening a Demat account on the HUF span. This can reduce your tax liability significantly. And if you want to know more, we have just made a video on HUF and how you can save taxes with it. You can find the link of the video in the description below. Now let's move on to the last bit of this video where we'll understand how to pay and file taxes. All individuals are required to file their income tax return by 31st July of the respective assessment year. But to file your ITR, you would require a list of documents. Let me give you a quick checklist. Form 16. If you are a salaried employee, you need to get this form from your employer by 15th June every assessment year. It has details of the TDS deducted on your salary throughout the year. Form 26AS. You can get this form from the income tax portal. It provides details of all the TDS and TCS deducted on your incomes and expenditures. Number 3 is annual information statement. The AIS is detailed statement of list of all your financial transactions for a given financial year, such as interest income, dividend, stock and mutual fund transactions, and international remittances. It's important that the information mentioned in the AIS matches with that in the Form 16 and Form 26AS. You can download the AIS from the income tax portal. Number 4 is capital gains statement. This contains your capital gains proceeds from sale of stocks, mutual funds, and ETFs. And it is important to calculate the tax liability on your capital gains. You can download the statement from your brokerage, AMC, CAMS, or Kavi. Last and the fifth one is tax P&L statement. This includes your trade-wise or script-wise profit and loss for all stocks, MF, ETF, intraday, and FNO transactions. The statement also includes expenses traders can claim, such as brokerage, STT, stamp duty, subscription charges, and exchange transaction fees. Next, you need to select the right ITR form. The Income Tax Department issues 7 ITR forms based on 2 things: the type of taxpayer and the sources of income. ITR 1 through ITR 4 are applicable to individual taxpayers like you and I. Now look at this table. ITR 1 is the most basic form applicable to salaried employees and is filed when you have income from salary, one house property, and other sources like interest income. However, if your total income exceeds 50 lakhs or you are an NRA, you will have to file ITR 2. In addition, ITR 2 needs to be filed when you have multiple house property incomes, capital gains, or any kind of foreign income or assets. ITR 2 is applicable for most investors. ITR 3 is applicable for FNO and intraday traders, as those fall under business income, while ITR 4 is applicable to businesses and professions opting for presumptive taxation scheme, a topic for another discussion. You can take a screenshot of this table for your reference. Also, if you want a detailed video on the different ITR forms, let us know in the comments. Lastly, one important thing you must understand is that paying taxes and filing ITR are 2 different things. Payment of taxes should happen as and when you earn income. This concept is called advance tax. Advance tax provisions apply if your total tax liability is equal to or greater than 10,000 in a particular financial year. Whatever be your tax liability, it should be paid in 4 installments across the financial year shown in this table. And in case you fail to pay advance taxes on time, you will have to pay interest penalty on your pending dues under Section 234B and 234C. Hence, investors and traders should not ignore advance taxes. If you want to understand how to calculate advance tax liability and pay it on time, we have made a detailed video on this topic a few days ago. So don't forget to check it out. We'll put the link in the description below. So that's it for this video. 2024 has started and all of you would be rushing to plan your taxes, followed by filing your ITRs in the next few months. So if you need our support for saving or filing your taxes, feel free to reach out to our team on social media or through our website. If you have any doubts from this video, suggestions for us, or if you want me to make a video on taxation for traders, let us know in the comment section below. If you found this video helpful, make sure to hit the like button and subscribe for more such tax related content. Until next time, this is Vishvajit signing off.